Welcome to those joining us. We'll be starting very shortly. Welcome, everyone. We'll be starting the webinar very shortly. Hello and welcome to this Innovation Forum webinar, the latest in our series discussing the energy transition. I'm Ian Welsh and I'll be your host for the next hour or so. Financing remains one of the greatest barriers to scaling the energy transition. As global capital seeks stable long-term returns, the challenge is to create financial frameworks that can de-risk projects, attract private investment, and deliver at the pace required. Traditional approaches, from government-backed incentives to public-private partnerships, continue to play a role. But new tools such as blended finance, transition funds are emerging with varying degrees of success. There's a lot to talk about, and we've got an expert panel to help frame our discussion today. We've Cecilia Tam from the International Energy Agency, Mark Schmitz from Rabobank, Maria Balanesa from Amberside Advisors, and Joachim Koefoed from the Copenhagen Infrastructure Partners. And my thanks to Innovation Forum's Lola Hart for coordinating the panel and bringing us all together today. I'll turn to our panel very shortly, but we do want to hear from everybody else. Please do be thinking about your points and questions that you'd like me to put to our experts and write them in the Q&A box on your Zoom window. Please note your name and organisation when putting your question. You can, of course, like others' questions by clicking the thumbs up, and the more likes, the greater the chances that I will put that question to the panel, and do try to keep them short if you can. We are also recording the webinar. I should have said that. We're recording the webinar and we will share the recordings with everyone in due course. Okay, let's go. Cecilia, welcome. Perhaps you can set the scene for us a little bit with some insight into the energy transition situation at the moment. And I know you just released the latest World Energy Outlook, so anything from there that's relevant would be very useful as well. Cecilia.
Thanks very much, Ian. And just to start by thanking the Innovation Forum for the invitation to join today's webinar. What I'd like to share are really some findings from the recent World Energy Outlook to really help set the scene for this webinar on financing energy transitions. It's important to highlight that the IEA scenarios are not forecasts. What we explore are the implications of different policy, technology, and market trends across different exploratory and normative scenarios. What we see is that the world remains hungry for energy. New technologies are entering the system at great speed, and renewables are setting new records for deployment. Oil, natural gas, and coal consumption and nuclear output are all reaching record highs as well. Driven mainly by China, since 2019, demand for coal has grown 50% faster than the next fastest growing fossil fuel, which is natural gas, a key reason why energy-related emissions have continued to grow. Now, if we look at the power sector, we see that electricity is really at the heart of modern economies, and electricity continues to grow much faster than overall energy use in all of our scenarios. For the moment, electricity accounts for only 20% of final energy consumption globally, but it's the key source of energy for about 40% of the global economy and the main source for energy of households. Renewables are on the verge of taking over coal as the largest source of electricity, and renewables have set records for deployment in each of the last 23 years, rising to about 685 gigawatts in 2024. This has raised renewables generation by about 80% over the past decade. With their low costs and favorable policies in over 140 countries, renewable generation more than doubles, rising from about 1/3 of electricity supply today to about half by 2035. Now, I'd want to share just a few key takeaways from the report. Energy is really at the heart of today's geopolitical tensions, from fuel supply to critical minerals, elevating energy security to a core issue of economic and national security. These threats are impacting thinking on energy transitions and also how governments and corporations are prioritizing energy investments. In addition to traditional energy security risks with oil and gas markets, there are emerging concerns such as critical mineral supply chains and high concentration in manufacturing of certain technologies that create both risks but also some interesting opportunities for transitions. Some common elements are visible across the IEA's different scenarios, such as growing demand for energy services, the age of electricity, and new countries setting trends, the rise of renewables, and the comeback of nuclear. We see that near-term oil and gas markets look well supplied, especially for LNG, but buffers can be quickly eroded and low prices could lead to investment imbalances and uncertainty over demand in the future. The world is falling short in its responses to climate change with very severe implications. And governments need to address urgent energy security challenges, considering synergies and trade-offs with affordability, competitiveness, and climate. And finally, to end, if we look at some of our tracking on current investment flows and future needs at different sectors, we really see three main concerns. First, energy efficiency and the slowdown we've seen in energy efficiency improvements globally. So while spending on end-use electrification is rising, especially for electric vehicles, stronger implementation of energy efficiency measures is needed to meet transition goals and also to improve security and help cut energy bills. Second, trends in investments for grids and other investment in electricity security are showing some worrying signs. Investments in the power sector now account for about 40% of all spending in energy, but how this is distributed is extremely uneven. 10 years ago, for every dollar that we spent on new power generation, we were spending about 60 cents on grids. Today, this has fallen to about 40 cents, meaning that today around 1,700 gigawatts of new renewable projects at very advanced stages around the world are being held up today because of grid connections are not available. And finally, there do remain major gaps in investment needs in our net zero by 2050 pathway. The technologies needed to reach net zero have much higher upfront costs, but also much lower operating expenditures. The largest gaps remain in the end-use sectors for efficiency, but also for end-use electrification, which need to nearly double over the next decade. And big increases are also needed for spending in renewable power, as well as for low emissions fuels and nuclear. Thank you.
Thanks very much indeed, Cecilia. Interesting thoughts on coal. I was just thinking as you were making your comments. I mean, the COP26 in Glasgow, some years ago, it was agreed that coal will be phased out. Yet you're seeing that coal demand is increasing faster than anything else. Does the International Energy Agency have any thoughts on how that can be addressed, or is that going, or if that's going to continue?
This is actually something that we see slowing down. A lot of this is driven by investment decisions in China, and a lot of the investments in coal, not only in China, but in India and Southeast Asia, are really driven by concerns around energy security. So in this year's World Energy Outlook, we are paying quite a lot of attention on how concerns at the national and regional level around energy security are really driving investments. But we do anticipate that renewables will take over likely next year, and that we are starting to see some signs of peaking by 2030 for coal investments as well. And this should all help drive down or allow us to reach that peaking in emissions. We continue to see great news on renewables development, and that will also help to address major security concerns.
Okay, thanks very much indeed. Quick response to our first question. The question's asking about visuals. This is a conversation-led webinar, so there won't be any visuals today. Will be discussion-led. Okay, Mark, welcome. Thanks very much. Perhaps you can follow up Cecilia's remarks with a bit about how financing trends are evolving, in particular barriers to investment, how they are being addressed, and other risks. Mark.
Yeah, thanks, Ian. What's important to know, I think, and also what Cecilia said already, it's important for us, for Rabank, the renewable energy and energy transition is a real growth pillar. It's one of it is the most important sector currently to grow, at least. We do with our team project finance around 60 deals a year for a total investment of 3 billion, and we tripled our business in 5 years. That is what you see, what the importance for banks is. Not only we, but also other banks. And we already in the market since the 90s. I'm working also 30 years in this business, so there are a lot of evaluations. What you saw, for example, until 2015, solar and wind transactions were mainly based on feed-in tariffs and subsidies. Yeah, it was quite easy to finance, no market price risk. Yeah, and a 50-year tenor or 20-year tenor, and then you could finance. For offshore wind, it was slightly more difficult because there you had construction risk. But for solar and wind, it was more straightforward. As of 2015, a lot of tariffs disappeared, not in all the countries, but in several countries. And what you saw is that merchant price risk was coming up, but as well, there were corporate PPAs, for example, Google or Amazon, they were kicking in. The first one for us was, for example, in 2016, a transaction with BlackRock in Norway and Google as long-term off-taker. That has changed. It's only 10 years from now. What you see as well, as of 2018, the first batteries were coming up because you see in the market negative electricity prices, for example, between 12 and for noon and 4 p.m. There's an overcapacity of solar, too much wind. Then, for example, countries as the Netherlands or Spain, a lot of negative prices. You can solve that with having a better interconnection or grid connection, or you can solve that with batteries. There you see in whole Europe, the batteries are coming up. Yeah. What you see as well, for example, in Sweden, the prices are very low. They were around 5 to 10 euros per megawatt hour, really low, because there is also overcapacity of wind. How to solve that and how to make it more equal. What we do, for example, in the Netherlands, we combine onshore wind with batteries, and in the UK, it is a lot of batteries. That was the first country we implemented many batteries. For example, we did around 20 to 25 transactions, of which 70% was in the UK. So the batteries was the main component. And in the beginning, it was first wind, and afterwards it was solar. What you see as well is co-located batteries with solar. In Spain, I was 2 weeks ago, I was in Spain. And there you saw that many of the investments are not anymore invested only in solar, but combining that with batteries. Otherwise, the business case does not work. We finance also many other technologies as well. Hydrogen is coming up not as fast as the batteries. Carbon capture projects in the UK is coming up, so that is there as well. Offshore wind is lagging. And why? Because the levelized cost of energy increased, I think, in the last 5 years from 50 euros per megawatt hour to 100. If you compare that, for example, with solar, they came down from 200 10 years ago to 15. Even you see some projects where the solar could survive with 30 euros per megawatt hour or even 26. That's substantially lower because the investment cost decreased enormously. What you see with financing structures, sometimes there are tolling agreements or floor prices to mitigate the market price risk of electricity, because not all banks accept market price risk. And if you accept market price risk, the tenors are shorter. We have some mini perm structures. That means, for example, there's only a 5 or 7 years tenor. What you see as well, that the equity must increase. Normally it's around 20-30%. But if you have market price risk, sometimes you see even 50 or 60% on equity. What you see as well in Europe, the transactions are becoming bigger. In the beginning, we saw many transactions of 40 to 60 million. Now you see a lot of transactions between 300 or 700 million. Not as big as in the US, because they're often above 1 billion. And you see a combination of solar farms or wind farms together. and then you have portfolio financings. What do you see as main issues in the market? Concluding bad or wrong corporate PPAs. You saw, for example, in the Swedish market, a lot of baseload PPAs were concluded. And that means, in fact, that if you cannot deliver electricity, you have to pay for it. And if there's no wind, you have to pay a lot of money. And there was a disbalance. Now you see not that kind of corporate PPAs. You see mainly pay as produced PPA. The deals in the Netherlands or Spain or Germany are not going easy in solar, but when you combine that with batteries, solar is accepted. Other countries like UK, Ireland, and France has less difficulties with the negative electricity prices, so that issue is less there. What you see in the offshore wind sector, there are delays in construction, sometimes even 12 to 20 months, but the investors or shareholders are so big, this mostly they save themselves that, so there's not a real issue for the banking. But for the investors, for return on investment, there are issues. And what you saw as well, that there are tenders failed in the UK and the Netherlands because the level cost of energy was too high, so they couldn't find investors. What you see finally as well, why the energy transition is going slower, there are a lot of grid connection constraints, also what Cecilia already mentioned, and also permitting issues what delay the projects. In my view, that are the main components. This was my presentation.
Okay, thank you very much indeed. How do you think in the medium to long term that the sector will get around the fact that success means less return for investors? I mean, it's a bit of a conundrum. How do you see the finance mechanisms adjusting to deal with that?
Yeah, I think first of all, the solar panels and the batteries, the prices coming down. The negative electricity prices will be solved in coming 3 to 5 years. That's also according to Baringa or Aurora, the market advisors. So on the long term, it will be better. Also for solar, the negative prices, I wouldn't say that they will totally disappear, but they will mainly disappear in a longer period. But this imbalance between batteries, solar, and wind. So yeah, so I think it's at the end it's positive, but the coming 2-3 years are tough for a lot of investors.
Okay, thanks very much. Lots to come back on there. Maria, welcome. Thanks very much for joining us. Perhaps you can reflect a bit from a project perspective then. What are the characteristics of energy transition projects and new energy projects that work well?
Ian, and hello everyone. It's great to be here and bring an advisory perspective to the conversation. As we help clients bridge the gap between a great technical solution and financially viable projects, that means helping develop and commercialize decentralized energy assets, structuring partnerships, finding the right funding, and ultimately closing transactions so that projects actually get built. And we work with infrastructure funds, utilities, energy service.
Sorry, Maria, just sorry to interrupt. I can't really hear you. Are you using your mic on your laptop?
Hello, is it better now?
That's better. Yep.
Yeah. Okay. So as I was saying, we're working with infrastructure funds, utilities, energy service companies, as well as public sector. So we see these projects from all sides, and across the project we support. I'd like to mention 2 trends that consistently stand out. These are partnerships and consortia forming, and also service-based funding models like energy as a service. So as Mark mentioned just now, clean energy projects are getting bigger, more complex, more interdependent, and really a single organization can just do it alone. And this is especially true in subsectors such as heat networks, EV charging infrastructure, smart local energy systems, behind the meter renewables. The project often face long and costly commercialization and delivery timelines, extended payback periods, policy-dependent economics, and exposure to energy price risks, of course. And an example is heat networks, which has a great cost-efficient way to decarbonize cities. And also 80 billion investment opportunity in the UK. But what really unlocked real momentum in the recent years is public-private model that's built around advanced zoning program and heat network zoning frameworks. So in simple terms, local authorities set strategic direction and provide certainty through zoning, and then private sector brings the capital and delivery capability. And of course, because these projects are large and multidisciplinary, we're also seeing consortia become the norm. A couple of quick examples of real projects. Bristol City launched in 2022 a 20-year partnership between Council, Ameresco and Vattenfall, aiming for 1 billion of investment. And also Project Swan in Westminster, Hemica and Vital Energy JV, backed by the Council, again, 1 billion heat network. So these sorts of models show the direction of travel, long-term partnerships, where each party brings something essential to the table. I'll move on to the energy service, which I believe truly transforms the customer-investor equation. Under energy as a service, the developer or investor funds infrastructure, and the customer pays a predictable service fee. So no upfront capex, listed performance and maintenance are all bundled in. Why it is gaining traction? Again, net zero heat targets getting tougher, public budgets are getting tighter, and energy as a service shifts a lot of financial and operational risks of the customer. That is incredibly attractive for public sector estates, universities, and healthcare because it makes decarbonization possible without the capital hurdle. We're also seeing more funded developer partnerships forming around this model, share construction, operational revenue, and procurement risks. And also that speeds up the project pipeline delivery by standardizing commercial structures and bringing capital in early.
Thanks, Maria. I'm going to ask one of my colleagues to contact you directly. Your audio, I'm afraid, did come in and out there. I didn't catch all of that. I think I got the gist, but thank you very much indeed. But we'll get in touch with you directly to try and see if we can get the audio issues resolved. But thank you very much indeed for now. Joachim, welcome. Let me ask a similar question to you. What are you seeing from a project level perspective, the characteristics that can work well? Perhaps think a bit about partnerships, how they can work well, and what sort of models are innovative models you're seeing. Joachim.
Thank you so much, Ian, and thank you also to the wider Innovation Forum team for setting this timely discussion up. I'm glad to be here, and also thanks to my fellow panelists here. You saved me a lot of airtime here because you have actually said a lot of the stuff which I also anticipated in doing. First of all, let me start by saying CRP, we are this global fund manager actually mobilizing a lot of the private capital, institutional capital globally, having now onboarded more than 200 investors globally, institutional investors globally. We're managing around 35 billion euros worth of equity, developing and investing in renewable energy projects globally across different segments. And I completely agree with sort of the overall conclusion from the World Energy Outlook, also outlined by Cecilia earlier. And the way we see it is not as gloomy as maybe Mark ended out saying that it will be difficult for the investors in the coming years. Of course, in some sectors and in some technologies, it's more gloomy than others. But when it all boils down to it, what we do in CRP, doing renewable energy, primarily generation projects, it is the cheapest and fastest route to new power generation. Full stop. So when we look at the numbers, what new power generation should be built everywhere on the globe, the fastest route to that is solar and wind. That cannot be debated, and that means that also when we zoom into sort of other regional areas, when countries and regions are considering how can we bring energy prices down, how can we make a more resilient energy system, and how can we at the same time continue to decarbonize, and in that order, affordability, resilience, and clean. I think that's sort of the way the world works nowadays. The 1 and 2 answer is to scale or to speed up the energy transition globally. So I don't think necessarily it's so gloomy gloomy out there, despite some challenging market developments over the last couple of years, and I'll address some of them. On the project perspective and partnerships, that's a question, Ian. I have sort of 3 examples, and Mark actually went through sort of the same approach, and that's quite nice because we are thinking on the same lines, which is great. And the 3 points are with regards to energy flexibility, so system flexibility with regards to batteries. The second is about offshore wind, and the third is about grids. So first, batteries. I completely agree with what Mark is saying, that the cost out of batteries we have seen over the last 3 to 4 years is without comparison. It's even the capex for the best battery energy storage solutions is declining faster than we saw with solar. So I think the numbers are around 70% cost decline over the last 3 to 4 years, depending on the geography you're in, which actually means that you can actually install batteries, both sort of utility scale, but also embedded in the projects with quite some nice benefits and upsides to the specific projects, but also to the energy system as a whole. So one example, and Mark mentioned it as well, without naming names, the UK and Scotland, the England and Scotland projects. That's a front runner globally on this, and CRP is actually building the largest battery projects on the borderland between England and Scotland these days, around 4 gigawatt of projects divided on 4 phases, so 500 megawatts projects each. And how we actually made those bankable, because we took sort of an early bet, if you will, and that was actually with a partnership with SSE, the utility in that region, where they actually saw the need to actually to find a way to move the cheap power, the excess power in the north in Scotland, where the wind is blowing a lot and there's a lot of offshore wind, and with the grid congestions in that part of the UK, where you cannot sort of transmit that power down to London at the pace as the offshore wind would need. So we actually entered into sort of a contracted revenue, sort of a tolling agreement on that, because they actually saw the need to have this. They didn't have the knowledge or the capacity to do so themselves at the same time. And we actually took sort of the risk jointly, sort of at the traditional utility player joining with an investor actually building these projects, now actually alleviating a lot of the grid build out, which is evidently needed in the UK, but we can actually sort of spread the investment out over a longer time in the UK just based on this. And we are seeing similar trends across the globe, also in CRP, not just Europe. We are doing these sort of investments in Italy, in Germany, and Chile, and Australia as well, but with the same sort of market fundamentals. So that's point one, to basically alleviate the curtailment risk, which Mark alluded to. Second, on offshore wind, completely right. Over the last 3 to 4 years, or 2 to 3 years, that we've seen quite dramatic capex increases for offshore wind. No one can neglect that, and that's also why we are seeing failed auctions, especially in Europe. The Netherlands being the latest example, Germany, Denmark, UK are other examples where the auctions without price guarantees, or whatever we call them, price floors. I think that was the word used by Mark. I think we completely agree that if we need to build all that offshore wind capacity needed, and I think it's evident. You look at multiple sort of forecasts, including the IEA report. Even though it's not sort of a forecast, offshore wind will play a role in most energy systems. So we need to build some offshore wind, but we at the same time need to de-risk investors to come in. And sort of the CFD model is a good way to go there. And at least personally, and from a CAP perspective, we look quite forward to the upcoming offshore wind summit in Hamburg, with the heads of state of the North Sea region, where hopefully they will sort of commit to put CFDs on a big chunk of volume for the next years. Last point on grids. That's also with regards to partnerships, and maybe I should say also when we do offshore wind globally for the second point, we also do that in partnerships. So Ireland is a good example there. We have been developing a big project, one of the biggest projects in Ireland with Statkraft, where we actually won one of those CFD auctions some years back. So we're actually progressing that project with the CFD, and likely also to reach or start construction very, very soon. On grids. Partnerships, that's the same borderline. I think we need to bring in private players. We need to bring in private capital, and a good example there is back from mid-10s. I think it's from 2015 or 2016, where actually CRP managed to form a joint force with TenneT, the German TSO, to actually build offshore converter stations. So we actually CRP today managed in an unbundled fund structure 5 different German offshore transmission assets. So these are billion euro investments that a TSO like TenneT have to figure out how to finance and make revenue of. And we actually managed to set up a structure where we can bring in private capital, private development competencies to actually deliver the project on time and on budget. And I think that's sort of the approach we have to do more of, especially if we have to get up to €1, which Cecilie also talked about in terms of grid investments and generation investments, because that's so immediately needed. Thank you.
Thanks very much indeed. Feels that the conversation is evolving, that where really the grid investment is a large part of the problem here, and a lack of investment. I mean, I'd like to bring everybody to talk about this, but begin firstly with you. How are you seeing projects evolving that are focusing on developing better grid infrastructure? I mean, you mentioned the example in the UK.
No, so I think there are many good examples out there, but I think we sometimes focus on the holes and not the cheese, and maybe in this case, actually there are more cheese than holes in terms of volume. And the most evident example that I see is sort of what works well. That's with regards to cross-border projects. So we are actually quite good at actually making. It's not simple, but it takes a lot of time. But when we talk about interconnectors in the European region, for instance, we actually have a framework on how to do that. That should be modernized and everything. But I think where we actually see the biggest lack of investments, that's in the inter-bidding zone transmission systems, and especially at the distribution level. And if you focus on the distribution level, that's sort of the whole cheese of it in terms of the lack of investments that I talk about. Mm-hmm. I think the numbers are on European scale, they vary, but I think we need to invest around 2.5 trillion euros in the overall grids for the next 25 years. Around, let's say, 2 trillion of that will be in transmission or distribution. And when we look in all our various geographies of the world, most of the distribution system operators, they are municipality owned to a big bulk of it. And if they just in Europe have to mobilize 2 trillion euros of investments, I question if the traditional tariff model is the best way to build out that volume of distribution grids at the pace that we need it. So I think we need to do something else. Maybe we need sort of someone to mobilize the private capital, to mobilize the municipalities and the DSOs and a bit more effectively to bring on board private know-how and capital.
Thank you very much. Mark, were you coming in?
Yeah, I think totally agree. I think the view I see it quite well from Joachim, but what you see, for example, on the grid connection with TSOs, for example, TenneT, for example, you know that they are lacking enormously. I think there's a big difference, because if that is more equal, then it works better. For example, the difference, and I'm sure that Joachim knows quite well, in Sweden is SE1 or SE2, the prices are 5 to 10 euros per megawatt hour currently. Okay, you can conclude corporate PPAs of 30 to 35 euros for the longer run, but at this moment the price is quite low. If you compare it, for example, to UK or Ireland, the price is around 70 or 80 for 70 pounds per megawatt hour, 80 euros per megawatt hour in Ireland. Those things in Spain, they are 30, but there's a lot of solar, so there are differences. I fully understand that there is a lot of business to do, but still you see, and I have seen many investors, and yourself as well, to be honest, from Monegros in Spain, and we know you quite well. So there is pressure on those deals. But the other thing, and what I said also, we tripled within Rabobank our business the last 5-6 years. Okay, that is also a signal, and it will be first. I'm quite long in the business, and first, we are not important for the bank. If I see in 2010 or 2008, yeah, what are you doing? Why do we have renewables? Why do we have project finance? That was told to me. I was one of the first in the team, or the first, and now you are a key player within the bank. That says already what's happening. Yeah, so it's really important, and of course, but what you see, there's more pressure, and you have to better look what are the good projects. And before 2015, I wouldn't say that you could finance everything, but it was much easier if the project was constructed on time, and the only issues were for Germany for the offshore wind farms, but the remainder was quite well. And grid connection is lacking, and the reason is that the batteries are really key, even more than solar. We do a lot of business, but I share your view as well, Joachim. I'm not too negative, but for the 2 years, it's more tough.
Thanks, Mark. We can come back to you in a sec. Maria, I wanted to bring you back in. I understand you've been able to do some technical changes to sort things out. So you mentioned some of the challenges around grid projects. I wondered, do you have anything else to add there?
Yeah, I guess to elaborate from a slightly different perspective and just check in. Can you hear me better now?
Yeah, that sounds better. Thank you.
Okay, awesome. I would say another way of tackling grid constraints is, I guess, bring generation closer to demand, and that's essentially to build more decentralized energy assets. So we're talking about integrated rooftop solar, on-site generation, battery storage, thermal storage, smart local energy systems directly into places where heat and power are needed.
Thanks very much. Cecilia, do you have any thoughts on, from the World Energy Outlook perspective, how grid transformation investments in I guess grid and in storage, how they are likely to evolve?
Yeah, I mean, I think a lot of the analysis we've been doing, the tracking of investments, are really pointing to some roadblocks that really need to be supported through greater collaboration between governments, manufacturers, as well as utilities. Earlier this year, we released a report looking at manufacturing supply chains for transmission and distribution. And in the case of transmission, we highlighted that there are not only escalating costs, so in contrast to the declines we've seen in solar and batteries, grid cable costs as well as transformers have really increased by about 70% roughly over the last few years. And not only that, delivery times have also extended, reaching as high as 5 years for certain specialty equipment like high voltage cables. So we do need to also address some of these manufacturing issues. And Europe, North America are really two regions that we see as being most critical in terms of some of these supply side constraints. And here, governments as well as utilities need to provide better visibility to manufacturers that the increase in demand for these cables, these transformers, will be maintained over the long term for them to come in with more manufacturing capacity. And I think here, when we talk about partnerships, it's really key to bring in all of these different players to provide more transparency. Governments also need to address issues around long risks around permitting and land access. And I think this is where some of these risks are needing to be addressed by different parties. And I think when we talk about partnerships, you have different pieces of these consortiums that really can help to manage some of these risks to eventually bring down some of the costs of financing these projects.
Okay, thanks very much indeed. Audience, do be thinking of your questions. We have some questions already, but thanks for those. But do be thinking of further questions. We'll turn to those now. We do have a question. In fact, our first question was about thinking further about the conundrum of energy production versus grid development. And our audience member highlights the case of Nigeria. Lots of energy production, but very poor grid infrastructure. I wonder, does anyone like to comment specifically on Nigeria? Mark, do you have any experience of projects in Nigeria and the difficulties there in terms of the infrastructure and lost energy potentially?
No, I think from our side, we have not financed in Nigeria or Africa at this moment, I think. And I think if it's the grid connection is more difficult. I know an onshore wind was done in Kenya. It took a lot of time, but again, it's also quite favorable subsidy schemes. But the issues are different, I think, than in mainland Europe.
Yeah. Okay, thank you. All right, let's move on. Another question on hydrogen, not something we've mentioned much about today. There was at one time hydrogen was going to be the future, but it doesn't seem to have come to pass. Our audience member actually asked specifically about CIP's status on hydrogen projects. So Joachim, perhaps you can comment first. Where are you in hydrogen?
Thank you so much for that question. I think Mark was sort of the only one in the sort of the introduction that mentioned hydrogen, and I think sort of our line of thinking and mindset have also changed a little bit. But to take a step back, CIP has, as I said, we have 35 billion asset on management, and 10% of that, rough figures, are allocated to what we call Energy Transition Fund, which is basically how to decarbonize energy-intensive industry on various technologies. So we can do hydrogen, we can do CCS, we can do generation that are attached to those sort of activities as well. And we have a sort of historically, and Mark alluded to that as well, we have been talking very much about hydrogen. We started maybe 3-4 years ago. We basically said all across the industry saying that green hydrogen would be a solution to all the world's problem. Basically, that was what we said. And I think we have came to realize now that the ramp up of hydrogen has taken a slower pace than originally anticipated, and we have to deal with that also from an investor mindset. So we've done several things, and I said we are not a P2X. We don't have a P2X fund or hydrogen fund. We have an energy transition fund. And right now in that fund, we are doing multiple CCS investments, which are looking quite good these days. And we also hope to take a couple of more FIDs within CCS over the next 3 to 4 months. But hydrogen is also taking pace. It's slower than expected. So one figure that I can share from our back of the envelope calculations. Recently, Germany implemented late, but they implemented the Renewable Energy Directive with regards to the blend-in, the green hydrogen blend-in requirements within the transportation sector. And Europe has all these sort of hydrogen regulation from the last European Commission mandate. But just that 1.5% blend-in in the transportation sector actually brings in the need to install 3 gigawatt of electrolyzers in Europe for the next 5 years. Today we have 300 to 400 megawatt of electrolyzers installed. So it's quite a big opportunity when just one member state, a big one, actually implements the regulation that's in place. So it takes slower pace than we anticipated, but actually there's sort of a light on the end of the tunnel. And we still have a quite big European portfolio that we progress. Things doesn't look rosy red, but they are not at all totally gloomy either.
Probably, Yogi, we are working on one in the UK, and we did also several CCS. But the difference with other projects currently is that they are based on subsidy schemes. Yeah, you see, solar and wind is not anymore based on subsidy schemes, and you see with hydrogen is too expensive at this moment. And if offshore wind will be a success, certainly in the North Sea, it should be great if it produces at the end green hydrogen also for Rotterdam or some ports. I think that should be quite helpful, but that's less easy than expected. But we see some traction, but not on the speed of batteries, for example. And CCS, big projects, but a few ones. Yeah.
No, but you're 100% right, Mark. And sorry, Ian, but I think we need to think about hydrogen differently than we did before. I think differently. Earlier we said we can just put electrolyzers wherever, and then we use the power to a capacity factor that's above 60 or 70%. But the reality is that today, and I think Maria talked about that as well, with regards to decentralized versus centralized energy systems. Where do we place these localizers so we can use cheap electricity, so we reduce curtailment, for instance? So let's say the North Sea or Sweden or Denmark or Iberia, where the electricity price drops very close to zero. Then we can use the electrolyzers that drives down the price of hydrogen, so the energy intensive industry can actually afford to pay for it. And that also drives the need for subsidies down. And I think that's the different mindset that we need to take on, a different hat we need to take on understanding the hydrogen economy.
And of course, building these electrolysis plants where there is this energy available is essentially a form of storage, because you're converting energy that would otherwise not be used into hydrogen, which then can be used at another stage. Maria, I wondered if you wanted to comment on where hydrogen is in your work, where you're seeing hydrogen projects developing.
We do not cover hydrogen, unfortunately, so cannot really comment on that. But to reflect on what everyone else is saying, to again reiterate that it's probably no single technology, right, would help us solve the decarbonization problems, and we have to think systematically, and sometimes it is even beyond sort of one country, as Cecilia mentioned, cross-government collaboration. It is about finding different tailored solutions, combining these technologies smartly. So innovation still has a role to play. We still haven't cracked it really. Yeah.
Okay, thank you, Cecilia. From the World Energy Outlook, rather, what do you see as the role of hydrogen at this stage?
We've been looking very closely at hydrogen for quite a long time across our different technology analysis. And it's clear, and many of the panelists have mentioned this, it's a critical technology we need for decarbonizing heavy industry, particularly the steel sector, fertilizers. And I think, looking around the world where you see some potential opportunities are, for example, in the ammonia sector, in markets where you're importing expensive ammonia. You've got lots of low-cost, perhaps excess renewables, and trying to find a good use case where you can geographically match well this excess low-cost supply of renewables with an alternative, let's say, where Brazil is a good example, where you've got a lot of renewables at low cost. They're importing a lot of their fertilizer, and that is coming at quite high cost. And so you are seeing some markets that are becoming increasingly competitive in these types of situations. And I think, as Maria mentioned, it's important to look at where we can optimize for some of these locational benefits, as well, to think about how we can accelerate on development of low emissions hydrogen. So looking for where we are curtailing renewables or where we're seeing lots of more frequent negative low prices, to then see where we could better localize the production and seeing if there's a nice offtake there. I think we've also talked a lot about or explored government procurement in creating early markets for low emissions material demand, whether we're talking about steel or ammonia. And I think this is where partnerships are quite key, public-private partnerships, to create those first early markets to demonstrate that there is demand for this and that projects can move forward from there. Thank you.
Thank you. Thank you very much. We have a question about risk mitigation. Questioners asking, what are the tools or risk mitigation tools that can be most effective to enable banks and financiers to come in and finance the energy transition projects? Mark, when you're looking at projects, what sort of risk mitigation tools are you looking for?
That's quite simple, I think. It is, for example, for the solar, wind, but also batteries. It's our long-term agreements with corporate PPAs of corporate parties like Google or Amazon, and you have long-term agreements, sometimes 10 or 15 years. But then, and it's also a figure from CIP, for example, you want to have the upside as well. Then you see also in contracts floor mechanism that you have a downside. That, for example, for batteries, if the average price is 70k per megawatt, then you have a floor price, for example, for 35k per megawatt. But then you share the upside with the corporate PPA provider and the investor. Those kind of structures you see. If the investor is not willing to do that, for a bank, then there's some more equity needed. For example, not 20 or 30%, but 50%. And you have also a front-loaded repayment profile. So you will find solutions there. What we do as well as bank is a construction bridge financing. So we do not, we will wait, for example, for concluding the PPA after the construction. That helps the investor to get a better price for the PPA. And then, for example, on the first time you ask for 50% equity, when a corporate PPA is concluded, then you can go back to 20 or 30% equity. Those kind of structures we're working on to mitigate that. But I'm sure that Joachim has also some ideas.
And he has his hand up. So Joachim, over to you.
Thank you so much, Mark. And I don't disagree. I'll just compliment that, especially on grids. I think right now, and focusing on Europe again, we have serious challenges when it comes to mobilizing grids investments. And I think if you look at it, I think we see several opportunities, basically leveraging public capital, sort of in a catalytic manner, and then we can discuss for more than the 10 remaining minutes on which model works better. But I think at least we can see, and when we look at the market to mobilize private investments for grids, as the regulatory framework is today, the returns are insufficient. So we need something to live up at least 200 to 300 basis points to bring in the big institutions here. And I think you can talk about subordinate equity, you can talk about passive equity or passive capital, if you will, but also guarantees. And I think at least modeling these out on a sort of in a structured portfolio level of a diversified grid portfolio, you would actually be able to lift those returns quite up there, so we can bring in private capital. One example is that one model results that I recall is actually when if we would consider using public money, EU money or EIB money to sort of a diversified grid portfolio of, let's say, sort of a fund size 2 to 3 billion euros, passive equity coming from the EIB, saying they first money in, last money out approach, not necessarily favorable return requirements. So they would still get a return, though that money, but due to the fact of the timing and difference between the private capital coming last in, first out, then you would actually be able to uplift the private capital by around 200 basis points, which would crowd in private capital. I think that those sort of innovative financing model that we should start thinking about how we can use public money catalytically rather than continuing the grants by grants approach.
Thank you very much. Cecilia, I wonder, just from IEA's perspective, what sort of risk mitigation measures do you look at or recommend or think about when you're looking at how projects will develop? Because obviously this is a large part of enabling further future energy projects to develop.
We've done quite a bit of work looking at different blended finance instruments, and the right instrument really just depends on the risks that you're trying to address. So I wouldn't say there's one optimal situation in every context, but for newer technologies, sort of first loss instruments can provide and get projects over the threshold. We also look at, have been calling for the need for more equity-based instruments when we're looking particularly at newer technologies, because we see that across different markets and for let's say, more nascent technologies, there is a clear lack of equity capital that we need to be able to raise debt. A lot of the development finance focus has been too much, in our view, on financing or direct finance of projects, not always in concessional terms. And so, looking for different guarantees that match the risk that you're facing, whether that's off-taker risk, then providing an off-taker guarantee can really support that. But it's I think the key takeaway is that we need to understand what is the risk that we're trying to manage to then best identify that right instrument. So I don't know if I could answer this question in the chat about developing countries.
That was going to be my next question. You're very welcome to answer it. Let's talk about. I think we have a question about the challenges in developing countries where there is a disconnect between public funding or perhaps not even much public funding available. So yes, Cecilia, I mean, how does the IEA recommend thinking about transition in such economies?
Yeah, I mean, I think the 4 countries that were mentioned in the chat, Bangladesh, Pakistan, India, and Vietnam, a couple of these are really very interesting cases of what and how the market is evolving. So if you look at Pakistan, over the last sort of 12 months, we've been tracking and following very closely developments in this country where you've had record additions of solar, and basically all driven by wealthier consumers trying to address high utility prices and poor service quality. So you've had more solar added this year than was on the grid because of these sort of natural market developments. And that also complemented by the fact that you have this huge oversupply of solar manufacturing, particularly coming from China at very, very low cost. So their consumers were able to respond directly to bring in quite a lot of solar power to meet domestic or self demand. But this has created a lot of issues for the debt-laden utility and many questions about what will happen in that market. Because now we actually will see more solar during sort of peak sun hours than will be demanded by the grid because you have very high levels of self-consumption. In India, we see this as perhaps one of the brightest spots in terms of investments in renewables outside of China, with rapid declines in solar, but also batteries, helping to drive renewables development in that country. In Vietnam, we also saw record deployment a few years ago, really pushed in by high feed-in tariffs. And I think what will really continue to drive a lot of the transition in these markets is the reality that we face, and I think was mentioned by Joachim and Mark, that solar and wind are amongst the most competitive sources of new electricity generation, and there the economics are extremely strong. What will keep these markets from going sort of even further are what we were already talking about, issues around attracting adequate investments into grids. I think rapid declines in batteries will obviously help as well. But at the end of the day, to continue that, sort of transition that we need for a net zero, we do need to address some of the transmission and distribution investments. And here in emerging countries, I think development finance institutions have a big role to play in enabling new capital to come in. They also need to look at how we can bring in more domestic savings into this transitions. And here, I think attracting in this question around the fashion industry, with many of these countries becoming and replacing China as sort of new manufacturing centers. Here, I think RE100 types of things, more of fashion looking at sustainability will also help to drive more self-consumption for renewables.
Okay, thank you. Maria, you wanted to come in briefly, please? Briefly, if you would, because I do want to continue. I do have one further question I want to cover before we come to the end. Maria.
Sure, very briefly. I think developing countries actually have this unique opportunity to leapfrog the traditional centralized energy model, as that they don't have to do large grid reinforcements or shift from the fossil fuel infrastructure. They can go straight to distributed renewables, microgrids.
Great. Well, thanks very much. I'd like to touch briefly before we close on CCS. Very quickly, we have a question asking, I think the question's asking about, do the panel think that increasing investment in CCS is a bit of a charter to retain using fossil fuel derived energy? Mark, do you want to answer that one very quickly, please? You're on mute.
Sorry, yeah, it's okay. Now it's a tricky question. What you said, I think it's too bold. I think it still makes sense. On the other hand, what I see as well, it's a lot of support, certainly for the UK government. And I think that's around 20 billion support, so it's a lot. Yeah, so I'm not 100% sure if that is the only solution. But on the other hand, hydrogen is lacking in speed to do that. So that is one of the solutions to lower the CO2. And only batteries is not enough. Then hydrogen should speed up. So I think it's one of the temporary solutions, to be honest.
Okay, thank you. Well, we are coming towards the end. I'd like our panelists to reflect a little bit on what they're taking away from the hour's conversation. So perhaps you can give us just the single thing you're taking away from the conversation today. Maria, you can go first.
Great. Thank you. I think fair to say the energy transition is now at the point where scale and certainty really matter. The risk opportunities are in billions for investments, and the project that succeed are those with clear risk allocation, long-term revenue visibility, and strong public-private alignment.
Okay, thank you. Mark.
I hope, and I think what Joachim said, is that the hydrogen will speed up, I think, and the cost will lower, but I like the lively discussion.
Thank you, Mark. Joachim.
I take with me quite an optimistic outlook for the energy transition, but also that the solution is partnerships.
Thank you. And Cecilia.
Joachim just took mine. So more just to reiterate that, I think, through the conversation we've had today, there is reason to be very optimistic in the outlook for the transition, particularly in Europe, really driven by both opportunities, but the need for strong partnerships to help better manage some of the risks that we're seeing in projects. Thanks.
Okay, thank you. Well, great that so much optimism. I'm going to have to draw the discussion to a close as we are now out of time. Many thanks to our panel for their time and insight today, and to you all for your questions. Conversation will continue at the first Energy Transition Innovation Forum in Amsterdam in April. Passes are available now at launch discount level. So there's a link and QR code there on your screen. We'll be in touch with webinar recordings in due course for you to share or listen again. But for now, I hope you found the last hour useful. I've been Ian Welsh. Thanks for joining us, and goodbye.
Thank you.